investors setting a high bar for a dovish Fed.
We're looking for degrees of dovishness.
Dovish. The market's already pricing quite a dovish view.
We're going to see this week how dovish the Fed is.
So the market really went to a dovish side when we had that December risk off.
The market needs dovishness, and if it doesn't get it, it's going to get disappointment.
Expectations for Fed hikes have been scaled back a lot.
Rate hike expectations being scaled back.
At most, they're going to be able to hike one more time.
To be honest, we think this is already the end of the cycle. We've seen the end of Fed rate hikes.
They've done this pivot to patience.
There's every reason to expect that they will be easy.
We've already priced in so much dovishness in this market. There's a really high hurdle going into Wednesday for the Fed to say something that would tremendously push us.
Let's talk about that high hurdle. Joining us around the table here in New York, Rieder, BlackRock Fixed Income CIO, Anastasia Amoroso, JPMorgan Private Bank, Head of Investment Strategy, and Robert Tipp, PGIM Fixed Income CIO. Anastasia, let's begin with you. It's a high bar. Can they hop over it?
It's a high bar, but I think the Fed does come in and meet these dovish expectations. I think, first of all, they have learned in December, and what happened in December is the market was begging for a pause, and they did not deliver. So I expect to hear a dovish message from the Fed, and the thing is they have at least 4 ways in which they can do it. We should be looking to statement, and I think the language there is going to be pretty dovish. We should be looking to the Fed dots, and we will see the revision in Fed dots down to maybe 1, maybe 0. But what's also interesting is the growth and inflation are likely to be revised up come 2021. So that's really kind of a good dovish statement there. And then, of course, the Fed balance sheet. That's going to be very much a topic for discussion as well.
What are you looking for, Rick?
I'd say Anastasia got it right. I mean, all of what you described. I also think, listen, I think the balance sheet, I think people have said, there are a lot of people say the balance sheet's not that big a deal. It is a big deal. I think ending it when they ended, I think they should end it early in the second quarter. I do think it is significant in terms of liquidity. We saw it play out last year. I think that is a significant thing. Listen, I think the longer-term dots, everybody will focus on the near-term dots, and the Fed will tell you, we don't really know after a year. That being said, I do think it tells you something about disposition, and I think the disposition is important. No matter whether it shows 0 hikes or 1 hike in the near term, they're moving to a posture. We're going to be in a lower rate dynamic for a long time. They're going to be willing to let inflation run a bit hotter, and that I'm going to watch that.
Robert?
I think it's going to take them an hour and a half to get to that outcome, because the forecasts, the dots, I think show participants at that meeting think later on this year they're going to be hiking rates, and the market is not accepting that. So I think the dots are going to print, and not that much has changed in the numbers, not that much will have changed in everybody's models. The mode at the last meeting was for 3 hikes, right? The median was for 2. So that'll come down a little bit, and that may be jarring for the market. And then he's going to have his press conference, and he's going to have to talk the market back to, we're going to watch, we're going to be patient, and the market will say, okay, they're going to meet us at the end of the year without having hiked rates, but it's going to take time.